Good morning and welcome to this week's OGTC Tech20 Virtual. My name is David Wilson and I'm the Knowledge Manager here at the OGTC and your host for today. We'll just take a few seconds to make sure everyone is here and then we'll get started. Ralph, if you want to press the video.
If you're interested in expanding your universe, each one of them will have something that's interesting and new.
It all takes place in the space of less than an hour.
The questions were very knowledge-based. Take the work hat off, look at something cool, and think about things in a different way.
Welcome to the Tech20 virtual series, our social showcase for speakers presenting technology-focused subjects in 20 minutes online. We're delighted to have so many of you join us online today. Before we kick off the presentation, there are a few housekeeping points. All attendees are automatically muted and your cameras are off. We're also recording the session today, so if you're uncomfortable with this, we'd ask you to leave the webinar now. We call these events Tech20 because we split them into 20-minute blocks. 20 minutes to hear from our speaker today, then 20 minutes for Q&A. We have two options for the Q&A. You can use the chat function to type in questions, or you can raise your virtual hand. We want to make this session as engaging as possible for both you and the speaker, so please do raise your hand if you feel comfortable speaking, and we'll bring you into the call when we're ready. If you want to comment on socials, please use the following hashtags, hashtag Tech20Virtual or hashtag Time2Tech20. So let me introduce today's speaker. Ralph McIntosh is a director in the Burness Paull corporate finance team. He has extensive experience in advising clients on a wide range of corporate and funding transactions, including mergers, acquisitions, private equity and venture capital investments, company startups, joint ventures, and debt financing transactions. Being based in Aberdeen, Ralph also has significant experience in the oil and gas and related technology sectors. Ralph is regularly involved in managing cross-border acquisition and financing transactions, and as a member of the firm's Norway and Houston desks, plays a key role in the firm's international strategy. Ralph, your talk today is titled Finding the End of the Rainbow, Accessing Funding to Fuel Growth. Can you tell us a bit about what you'll be covering?
Yes, thank you, David, and good morning, everyone. Thank you for joining us. Today I'm going to talk about the key features of the common funding options that are available to growth businesses along its journey of growth, and give some tips on ways that you can position your business to access those funds as efficiently as possible.
I think we've got your colleague there, Callum, is there as well. He's there as a sub should you need to bring him on, yeah?
Yes, that's right, I think.
Okay, you ready? Your 20 minutes start now.
Thank you, David. Okay, everyone, two of the most important jobs for anyone developing a growth business are firstly driving the commercial development of the business and its products and services, otherwise there is no business there, but at the same time ensuring that the business has the access to the funds that are needed to help it grow. Those two key tasks are often very difficult to balance, and sometimes it might feel near impossible, as both can be extremely time consuming and challenging. But hopefully there is some good news in that with a bit of planning and knowledge, you can equip yourself to better understand the financing options available and position your business to be able to access the right funding option at the right time. If you can do that, it'll give you more time to commit to the commercial development of your business and ultimately help you grow. It's worth noting at the outset that Scotland does actually have a very well developed ecosystem for funding early stage and growth businesses. There are a number of active and very well organised angel investment syndicates, and the other key benefit that we have in Scotland is matched funding that's available from the Scottish Investment Bank for many equity investments. There are a huge number of financing options available, and there's no one size fits all solution. You could group the options in any number of ways, but today I'm going to go through the main options in the order along a company's growth curve in which they're most usually accessed. As we go through, I'll explain the key features, advantages and disadvantages of each option. I'll touch on some other support options to consider or things to keep in mind, and then I'll finish up by explaining some actions that a business can take to make any form of financing process a bit less painful and less time consuming. As we go through, please keep in mind that all of the options are different, and it really is important that founders and shareholders understand their own business, its stage of development, and its likely future goals in order to properly assess the best financing options available to it. So first we'll take a look at early stage businesses, by which I mean businesses that are effectively startups, maybe pre-revenue and almost certainly won't be generating any profit yet. The most obvious first source of external funding for these early stage businesses is via the business support mechanisms and bodies that have been set up to stimulate growth business. There are three broad categories of these sources. The first is public funds from bodies such as Scottish Enterprise, Highlands and Islands Enterprise, and the Scottish Investment Bank. There are private grants from the likes of the Prince's Trust, Edinburgh Centre for Carbon Innovation, Opportunity North East, and of course OGTC. And there are competitions as well, for example, Scottish Edge, Converge, EIE, and CivTech. The funding from these sources can be a complete mixture between grants, prize money, debt, and equity funding. Each provider does offer something slightly different, so it's important to understand the detail and specific terms that apply to each funding offering. In general, these types of funding are best suited to early stage businesses, but some of them will only be accessible to businesses that are a bit further down the growth journey or that have other sources of funding available. For example, the Scottish Investment Bank matched funding by definition requires a separate commercial investment to be matched, and the Scottish Enterprise Smart Scotland funding will only fund up to 35% of a project, so you need separate funding for the balance. The process for accessing these types of funds varies between funders, but in general, it typically involves an applicant business demonstrating that it meets specific criteria set down by the funder, and usually in a set form of application for the funding. And once that application has been approved, there might also be certain conditions that the applicant business has to achieve before the funding is released. The most obvious advantage to grants and competition winnings in particular is that they don't have to be paid back. They're effectively free money for a business, and that's obviously a great advantage to an early stage business. Loans obviously do have to be paid back, but these bodies tend to be quite friendly lenders, and the terms are usually quite favourable. If the investment from these bodies is on an equity basis, that does dilute existing shareholders and lead to loss of control. But again, these bodies are supportive co-shareholders generally, and they'll usually give founders a fairly open license to go on and develop the business themselves with minimal interference. And competition processes, anyone who's on the call that is part of the OGTC cohort will know that these are very competitive processes that are very difficult to win and get to the end of, but even if you don't win, they provide positive publicity and exposure for the businesses involved, and they can help you identify and focus on any key shortcomings of the business that should be addressed to make it more investable in the future. And another advantage of these options is that they often give access to softer support mechanisms such as mentoring and contact with experienced individuals who might be prepared to offer guidance to your business without any charge. The final advantage is that these processes tend to be either very low or no cost, as they're generally binary processes. You either accept the terms and get the funding, or you don't and don't get the funding. A few disadvantages to these funding options. The main one is that the level of funding available is generally quite limited, and it might be viewed as insufficient to help some businesses with their growth goals. It can also be a time-consuming process to first understand the options that are available and whether your business would qualify for it. On that note, I'd recommend that any business begins the process by looking at the business finance support sections of both the UK and Scottish Government websites, and with speaking with local contacts at Business Gateway and Scottish Enterprise, both of whom are very good at understanding growth business requirements and also the various funding options that I have available at any given time. Finally, just a note on the grant funding options, some of those, while they don't generally have to be repaid, do come with conditions attached that might require them to be paid back in the future on the happening of certain events. For example, another financing of a certain scale, or if it was to support jobs, if those jobs are lost. So it's just something to keep in mind if you have access to that type of funding. So that's a quick run through the early stage options, but at some point a growth business will hopefully become more established and will need funding that is more extensive than can be raised from those early stage options. At this point, the choice for most businesses will be between either limiting growth, which is not a great choice, or taking on third-party equity investors from the private sector. There are a number of options for raising third-party equity funding. One popular option is angel investment, which involves individuals lending their own money to early stage businesses and also acting as mentors in exchange for shares in that business. This can be and was traditionally done on the basis of direct investment by the individual angels, but there are also, as I mentioned earlier, in Scotland, some well-established angel investment syndicates, including Par Equity, Archangels, Equity Gap, Kelvin Capital, EOS, and based in Aberdeen, Alba Equity. These syndicates can offer many of the benefits of traditional angel investment, but without some of the downsides. Angel investment works very well for many businesses, and some of the key benefits are that an angel is usually or almost always an experienced business person that has industry experience and can use their own contacts and experience to the advantage of the business, and also to add important credibility to that business. Many angels also have a higher capacity for a risk than traditional financing firms, and so they may be prepared to take a gamble on a business opportunity that might otherwise struggle to obtain equity financing. An angel investment is also likely to be a relatively low fee investment, and angels don't generally charge ongoing management fees, although that will be slightly different for a syndicated angel investment. Angels also don't work to fixed, or generally don't work to fixed exit timetables or investment cycles in the same way as private equity or venture capital investors do, and that in some circumstances might allow angel investors to take a slightly different perspective on certain decisions for the business. All of that's obviously very positive, but there are some downsides to angel investment. The main fundamental one is that it can be difficult to find a suitable angel investor that is prepared to invest in a specific company. And it can take a lot of time to, even if you can find an investor, to locate a suitable investor. As with any significant equity investment, there will be a loss of control for founder shareholders. And an angel wouldn't just give up their money without some protections for that, so there will also be some protections in the documentation for the angel. Also, perhaps unique to angel investment is that While it may be unlikely, there is the possibility of an angel's decision-making and commitment to the business being influenced by external factors that are out with the business's control. For example, the fortunes of other business ventures or developments in their personal lives. But again, that's something that is less of a risk if it's a syndicated angel investment. Another option is equity-based crowdfunding. That's something that Brewdog has quite well publicized, been using in recent years to raise quite significant capital, and it's been very successful for them. That generally involves groups of individual investors buying shares in a company to help it grow. We've seen a number of companies use the online platform Seeders in the last couple of years to successfully raise equity funds, but there are a number of equivalent platforms operating in Scotland, and most of them operate on a fairly similar basis. The main advantages of an equity crowdfund are that it can open the door to a significant pool of investors and reasonably significant investment sums. The investors can also be incentivized to invest on a tax efficient basis because many of the investments can be set up as either SEIS or EIS schemes. Despite the large number of potential investors, the documents and investor relations process are often streamlined because the crowdfunding platform itself will usually pool all the investors into a single point of contact for both documentation and reporting requirements. And the fact that it's usually built of a wide range of small investors does mean that there's no single investor with a significant investment that therefore expects to have a big influence on the business going forward. There are, again, some downsides though. The nature of these platforms often requires that financial reporting is shared online with the significant investor group. That might make some businesses uncomfortable because there will be confidentiality agreements in place, but it does make it difficult to control where that information might ultimately end up. There will, as I've said already, on other equity investments, be a giving up of control by founder shareholders, and the investment documentation will be difficult to negotiate. It does tend to be quite a binary process in terms of the documents are what they are, and you have little scope to negotiate any terms that are perhaps not well suited to your business. Also, to run a successful equity crowd fundraise, there's a good chance that a business will have to effectively secure an anchor investor that will underwrite a large chunk of the investment, and if you have to go through that process, then you might feel that you're better focusing on getting a direct investment from that underwriter. And finally, a point that's fairly unique to crowdfunding is it's a very public way of raising funds, and it's not guaranteed to succeed, and some businesses might be concerned how a failed crowdfunding effort might reflect on the business going forward. So that gets me to what is the most established option for companies looking to raise third-party equity funds for the first time, and that's venture capital. VC firms invest in smaller businesses that have high growth potential in return for shares in that businesses. Many businesses at the VC investment stage will still not yet be making a profit, but what they definitely will have is high potential for growth. Key advantages of VC investment are that they generally provide access to larger amounts of funding than an angel investment or a crowdfunding process will. A VC is also likely to be able to give strategic advice and support with growth plans, and they're likely to be very focused on growth and help you drive that forward. The disadvantages are that there's likely to be a significant loss of control for founder shareholders, and there will also be various conditions attached to founder shareholders' equity in the business, including leaver provisions. VC funds, as I've touched on already, have a fixed lifespan, and their investment decisions may well be influenced by a desire to exit investments in line with that lifespan. The higher risk taken by VCs does mean that unfortunately some of their investments will fail or result in a loss to them, but to balance against that, they do typically expect a high level of return from their successful investments. Compared to an angel or crowdfunding process, a VC investment can potentially be more complex and costly, and also a bit more time consuming. It's also This isn't necessarily a disadvantage, but something to bear in mind. A business will need a very detailed and robust business plan before embarking on any VC investment process. And as part of the process, the management and founders will have to be prepared to give warranties and stand behind that business plan. So after the VC stage, hopefully the business continues to grow and will eventually get beyond the stage that a VC investment is the appropriate funding package. And at that stage, the natural next step in a funding journey is likely to be a traditional private equity investment. PE firms generally look for investment opportunities where a business has proven potential for growth in an expanding market, has a well-researched, detailed and documented business plan, and has an experienced management team on board. Generally, PE firms prefer more significant investments than VC firms, and PE are interested in more mature growth businesses. But to be honest, if there's a real growth potential, they will be interested in businesses at all stages. It's probably fair to say that in general, PE firms have less of an appetite for risk than VC funds, but in general, the funding available is greater. And while PE funds still expect a significant return, their expectations are probably lower than those of VCs. The structure of a PE investment will usually include a mixture of debt and equity financing, and it can often also bring along bank lending to provide additional non-dilutive funding to leverage the investment. PE firms generally look to hold investments for between 3 and 7 years, and there's a wide range of investment preferences between different types of PE firm, and it is important that you understand those preferences so you can avoid wasting your time pursuing an investment from a firm that might just never invest in your business, no matter how good the potential. There's a useful directory of PE firms with some of the details of them on the BVCA website. I've included a link to that at the end of the presentation, so anyone can go and have a look if that would be useful. Your advisors will also be able to introduce you to their private equity contacts and help you in identifying the right private equity firms to approach and introduce you to. And the high-level main advantages and disadvantages of traditional PE are quite similar to those mentioned for VC investments, but because the business is likely to be at a more advanced stage and the risks of investment are generally lower, there's a slightly different dynamic between management and the investor. Founders or management will be in a stronger position to negotiate certain points in the documentation, but the PE firm will also be more focused on minimizing its risk. So the focus is slightly different. A PE process is generally a more expensive and bespoke process than a VC investment and will involve a much more detailed due diligence exercise on both the financial and legal aspects of a business. But those things are just a reflection of, firstly, the higher investment sums involved, and secondly, the slightly lower risk appetite of the investor. So just quickly, having cantered through the kind of main options at the different stages of investment, what's the options after a PE investment? Probably the most common option is a new PE investment, which would involve a secondary private equity investor or fund buying out the existing investor. Many businesses go through that process a number of times, half a dozen times even. Those processes usually involve management or founder shareholders rolling over at least some of their equity into the purchasing vehicle, but they do often allow them to get some cash out as part of the process as well. They can also be structured in a way to allow perhaps more senior managers to retire and step away from the business entirely, while at the same time introducing successor managers to the equity pool. The other common option, if a buyer can be found, is a trade sale to an interested trade buyer. If that is the exit option, then it usually results in founders exiting the business entirely, at least as shareholders, and almost always down the line a bit as employees as well after a short transition period. The other option, which isn't often pursued by Scottish companies, and if it is to be, it's only really suited to quite large-scale businesses, is to list on a stock exchange. One other option, or one other thing that should be kept in mind when thinking about any of these options and what you might do to secure funding for your business, is to just have a think about whether you can manage a bit longer or how long you can manage without the external investment. In doing that, these are all quite obvious things, but you need to ensure that any revenue streams are being maximised, any external spend that isn't essential is being kept to a minimum, and generally that the business's finances are being kept in order. This does sound like an obvious point, but the benefit of it from a funding perspective is that it might just be enough to buy you the time to overcome certain specific hurdles or achieve key development goals that will allow you to access a much better or more advantageous financing package in the future. So it is something that you should think about carefully, and if it can be achieved, it might be worth considering. Another alternative option that a number of our clients have pursued in recent years is a corporate venture. This might be where you have a product or service that isn't quite ready for commercialization or to go to market, but you also have a customer that is perhaps a blue chip potential client that is very interested in the product, has confirmed they would buy the product, and those discussions might lead you to a position where that customer is prepared to invest sums to help you move the product or service along. These arrangements can be beneficial as they obviously provide a key anchor customer as well as the capital you need to get to commercialization stage. But you do need to take care if you enter into an arrangement like this that you don't tie your hands for future development, for example, by giving that customer exclusive access to a product or agreeing to onerous licensing terms, maybe on a perpetual basis, or possibly any onerous royalty terms. We're obviously still in the midst of the ongoing COVID pandemic, so feel it's something that I've thought mention is that all businesses should take the time to, if you haven't already, be aware of all the support options available via government, and make sure that if you're entitled to access those support options, you think about whether that might be beneficial to your business, and again, if that would allow you to tide the business over to a position where a better funding package can be accessed. And also linked to the COVID pandemic is that governments will be announcing a host of measures to help economies emerge from the disruption caused by the pandemic. And just last week, the Scottish Government unveiled a huge range of specific support measures for the future to help the Scottish economy emerge from the pandemic and to focus on transitioning Scotland to become a zero emissions economy on a net basis. Some of those support mechanisms were pretty significant, including a £100 million Green Jobs Fund, £60 million to support decarbonisation, a £2 billion capitalisation of the Scottish National Investment Bank over a 10-year period, and the launch of a £3 billion green investment portfolio. So we're talking about significant sums of support that are going to be available in the future. And the point I'd make on that is that businesses should make an effort to be aware of these future support mechanisms, and if it's going to be possible to access them for you in the future, you should position yourself to be in a good position to do so. So having cantered through the different options available to businesses at different stages and the kind of growth funding journey, what is there you can do as a business to prepare to obtain those investment funds on the most efficient basis possible? And the first thing I would say is, and I've kind of been a theme of what I've spoken about, is to continually be aware of the options that you have available. You should keep an open mind and continually assess which option might be best suited to your business. And you should try to look forward on an ambitious but also a realistic basis to forecast what your future financing requirements are likely to be, because what you do now will influence your options at a later date. I'd recommend that you speak to people as much as possible and build profile in the market, because many of the options, for example, finding a suitable angel investor or PE firm or VC firm, very much rely on being able to get in touch with the right people at the right time. And it's difficult to get in touch with those people on a cold basis. It does help if you're able to be introduced by somebody that knows the relevant firm or person. For once you do get into any investment process, it's important that you are well prepared for the inevitable due diligence that will go with that process. Top of the list for that is to have a robust, absolutely rock solid, sound and detailed business plan that you are absolutely prepared to stand behind and is ambitious but realistic. You should make sure that all of your financial, corporate and contractual documentation is absolutely in order, because if any of it isn't, that will be identified as part of a process and it will just have to be sorted out at that time and may delay the funding. And you should also make sure that all of your key documentation is stored electronically so that it can be quickly and easily accessed and provided to investors. And that sounds like a very simple point, but it's one that's easy to let slide, and it can cause significant delays and frustrations, as well as taking up huge amounts of management time at a very inconvenient time if relevant documentation has to be collated and put into electronic format as a reaction to a funding process. And the final diligence point I'd make is that make sure that you can answer any questions on the protection of any of your IP and any unique aspect of your business that gives you a competitive advantage, because that's something that any funder will be particularly interested in identifying and having comfort on. You should have a sense of the true value of your business and what you're prepared to give up in exchange for a funding package that works for your business. If you don't have a clear sense of that, then you might well waste time negotiating a funding package that in fact you're not even prepared to access yourself. It's also important that you're able, and this should form part of any business plan, but it's good to extract it as a specific action, is to be able to clearly articulate what the funding being sought will be used for and how exactly that is going to facilitate growth of the business and ultimately a return to the investor. And finally, I would say use any resources at all you have at your disposal: mentors, professional advisors, customers, anyone really that can give you an insight to keep you up to date with the options available, introduce you to anyone that might be interested in funding your business, or to help you gain any access to funding. Appreciate that's a very quick canter through the options and things that you should be looking at to help the process go more smoothly. But if you can do all those things, then you should be in a much better position to pick the right funding option at the right time, and any funding process should go much more smoothly. And ultimately that will save you time and money and will be good for growth and allow you to spend more time focusing on the commercial development of your business. I've just got a final slide here that has a few useful web links that would help give a bit more color to any of those any of the points that I've spoken about, or give some information on any of the funders for the different types of funding. And just to conclude by saying thank you again to everyone for attending today, and thank you again to the OGTC for giving me the opportunity to speak today. And I'd be happy to take any questions now if anyone has any.
Thanks, Ralph. That was really interesting. I'm sure sparked plenty of questions from our audience. Just to give people a bit of chance to gather their thoughts and to either put their question in the chat or to raise their hands. I've got a first question lined up from Darren Nicol. He is one of our TechX cohorts, recent cohort, so I'm sure this is a subject that's very, very close to his heart.
Yeah. Hi there, Ralph. How's it going?
Hi, Davin. Good. Thank you. Good to hear a familiar voice.
Thanks for that presentation. It was, as you said, it was a canter through it, but it was fantastic on the options out there and the landscape. So, as mentioned, we're part of the TechX program, so we're hoping that the OGTC funding will take us, get us a little bit of traction. But somewhere along the line, we'll be thinking about maybe VC, angel investment, crowdfunding type route. But one thing you said that really sparked my interest, if you like, is that you mentioned that what we do now will influence our options moving forward. So one thing we're looking at is becoming a B Corp. Now, I just wondered, that's obviously quite a big decision for us. It's looking at going a triple bottom line organization. I just wondered if you had any experience around that and what that might mean to our funding landscape moving forward.
That's not something I've got specific experience in, Darren, but the point I was making on the options that you choose now influencing what you do going forward, I don't think that should have a massive influence. It will be more the underlying business and how it achieves its growth that influences options going forward. The kind of thing I had in mind when mentioning that was that if you go for one specific type of investment, for example, if you go for the VC, they'll control your exit process from that investment likely, and that means that you'll be tied to their likely timescales and desires for investment. It was that type of thing that I had in mind rather than the structure of your company.
Okay, I've got you. So it's more that if whoever you think about taking on board might influence your future decisions, if you like.
Yeah, exactly. And from the structuring perspective, then it is relevant to consider it but it'll be relevant to the extent the structure either limits the potential growth going forward or results in increased liabilities going forward. But it doesn't sound like that would generally be the case for this decision.
Okay, cool. I've got probably other questions, but I'll let others jump in. Thanks for that, Ralph.
Thank you.
Okay, I've got a question from myself here. You mentioned that the downside to equity-based investments is a loss of control for shareholders. So what type of things investors typically look at to have control over?
Yeah, that's it's something that goes hand in hand with any equity investment, is that the equity investor will expect to get something in return for their money, and they'll expect to be able to control the business probably in a way that is in excess of the control that they would get via their shareholding on a company law basis. The control will be in relation to a number of matters. First, as I mentioned to Darren, the investor will look to have a degree of control over any exit process, so any sale of the shares in the business. They'll likely do that by including drag or tag provisions in the company's articles so that it can control whether all the shares are sold at one time or not. That's a kind of high level control they'll look for. They'll also look for effectively day-to-day controls on the business to allow it to protect its investment. Those types of things will be things like the business won't be allowed to take on additional debt without the investor's consent. It won't be allowed to take on employees on salaries above an agreed number without investor consent. It won't be allowed to deviate from an agreed business plan for capital expenditure, etc. That type of thing beyond what has been already agreed in a business plan. Basically, they won't be allowed to issue shares to any other potential funders without the investor's consent. These things are all focused on protecting the relevant investor's investment, avoid it being diluted, and avoid the company exposing itself to liabilities that might impact on the investor's investment. And there's sound logic to all of that, but it can be frustrating for a founder who's had full flexibility to operate their business as and how they want to, up to the point of an external investment. But it's something that just goes hand in hand, and I think if you stand back from it, most people would agree that it is reasonable for an equity investor putting money in to expect those types of protections.
Okay, thank you for that. We've got a quick comment, I think, from Callum.
Thanks, David, and thanks very much, Ralph. That was great. I'm a colleague of Ralph's, and I suppose my team are less on the corporate finance side and more on the technology, IP, and contracts advisory side. And it was really just a quick point to pick up on something that Ralph said around the preparedness for diligence, because we deal with a lot of early stage tech companies, both in oil and gas and energy, but more broadly, and we see the same mistakes, early stage mistakes cropping up all the time, quite often around complex crowdfunding structures, employee share schemes that have been put together hastily or on a budget, some intellectual property issues around use of consultants and not being properly documented in terms of the transfer of IP, and basic contract mistakes around not having written contracts in place or everything being done in a handshake. And I think if you can get these things right from an early stage, I think that makes a huge difference when investors come in to look at the state of the business. So as well as the kind of progressive business planning piece, just making sure those early stage pieces are got right, and dare I say it, to spend a wee bit of money just getting that right at an early stage to save a whole lot of resource and money and pain at a later stage. So that was really just I just wanted to add that diligence ready piece.
Okay, I've got a question here from Victoria in the chat. So she says, you mentioned the future fund support that is available until the end of this month. What form does that support take, and what are the eligibility requirements?
Yeah, we've had a couple of clients access that support. It comes in the form of convertible loans. They are for amounts between 125,000 and £5 million directly from the government. To access it, you need a private sector funder to match the loan. So if you want 125,000 from the future fund, you need to find a private sector investor also happy to put in £125,000. To be eligible, a business has to have raised already at least £250,000 in equity investment from third-party investors prior to April this year. So that does probably rule out a number of businesses, and the business itself must have been incorporated before the end of last year. It also must have, I think it's at least half of its employees must be UK based, or half or more of its revenues must be UK based. If you can tick all those boxes, then the funding is provided as convertible debt funding, so it's on the basis of a loan agreement with the option to convert that debt to equity. It is quite expensive debt funding. I don't have the exact terms to hand, but from memory, I think there's a 100% premium payable if you pay the loan back as debt, and if it is converted to equity, I think there's a 20% discount on the lowest price paid in the last year for equity. So it is either discount to equity or very expensive debt, but what it does do is give very quick and easy access to a pretty decent amount of cash potentially in very short order. So it might be a good option for some businesses who are keen to access a good amount of funding now and potentially have an investor on hand that could give 50% of it. And just the final thing to mention is that your matching funder invests on exactly the same basis as the future fund, so they would get the 100% uplift on the debt or the 20% discount on the future equity conversion.
Okay, we've just got time for one last question, which is on the chat before we wrap up. So this is from Keith Hunter. Have you seen any change in appetite for equity funding or debt funding over the last few months since COVID lockdown, or is more robust business plans required?
Good question. There was definitely a change in the kind of early stage. I think likely due to the obviously massive uncertainty at that point. March, April, a lot of the investment work we were doing just evaporated because the investors effectively didn't have an idea of what they were going to be investing in. until there was a better handle on how the COVID situation was going to develop. But since that time, things have come back. I wouldn't necessarily say there's more robust business planning required, but what there definitely is, and any VC or PE firm I've seen involved in deals during that time has wanted to do, is very much understand what businesses have been doing to deal with COVID, what steps have been taken, and there's an acceptance though that business plans, projections, etc., are absolutely subject to COVID developments, and businesses may not be able to accurately forecast because of those things. There's still good interest from all the VC and PE firms in investments, but there probably is, it's fair to say, a focus on businesses that are less exposed to the COVID environment, and even there are a number of businesses have actually benefited, and those types of businesses have been able to generate a lot of interest in potential funding processes, and most of those are exclusively online businesses, tech businesses that we've seen.
Okay, that just about wraps it up for things this week. I'd just like to thank everybody for joining us, for their attention. If you want to check the screen for the QR code, that will let you see what next week's virtual Tech20 is. Once again, I'd like to thank Ralph for speaking today. And
thank you.
Thank you, and that's it. Thank you, everybody, and have a great weekend.
Thank you very much, everyone.